All right. At this point, we have basically gone through and built out what we would call all of our after-tax operating cash flows. We also have information about the assets that we're going to need. Again, what you're not seeing in this at this point are you're not seeing anything that is accrual based, like accounts receivable or accounts payable or any of that sort of stuff, because we're working on a purely cash basis. You will have inventory as an asset, but from our standpoint, that inventory is already captured in the purchase of the um, goods initially, and so it would be double counting to consider it again. Um, we don't have any financing, so we don't have any interest charges in particular. We don't have any debt in here. One of the fundamental principles of doing these kinds of analyses are that you don't make any debt financing assumptions at this stage. That's going to get addressed at a later date. So, in a lot of senses, that dramatically simplifies what needs to happen. And so, really, all we need to do at this point is a couple of things. One is we need to get a full sort of period by period accounting of all of the what we would call operating cash flows, and so that would include both money spent in the operation and received in the operation, but also money outflows from asset investments or inflows from asset sales. And one of the elements of that will be terminal value, and we'll talk about that. So we need to get this operating cash flow. The other thing that we need to do, just for good measure, is we need to figure out what our cash balance at each point in time is. Early on in the course, I discussed the fact that companies run on cash, and running out of cash would be a bad thing. And so in your forecast, you need to be able to demonstrate that at each point in time that the company will have adequate cash. If it doesn't, then you would need to infuse additional capital in the form of cash, either at the beginning or at some point along the way, to make sure that it has enough. And so there is sort of a feedback. If when we get done with the cash balance, we don't have enough cash, then we have to turn around and do something different in terms of the investment. And I'll show you how that works. So first thing that we're going to do is we're going to grab the after-tax cash flows that we calculated above. They're right there. Okay. And we'll just string those all the way out. And then we need to figure out what our asset investments are. All right. And so key here is that this is a cash flow type analysis. So rather than the way the balance sheet does it, where we would be showing the book value of the assets each time, here we just want to show it the one time when we spend the money on it. Okay, and notice that's a less. I'll show that. And then in all the future periods, we'll just set it equal to 0. I'm just going to leave it blank. It doesn't have to have a 0 in there for this to work. And we don't have any asset sales, so we'll leave it as that. And so our operating cash flows are simply equal to our cash flows from the business minus the money we spend on investments, plus, I did something wrong there, sorry, plus any money we get back from selling our assets. Okay, and so we can extend that all the way out. And that becomes our operating cash flows through year 10. Okay, pretty straightforward, I think. And I'll go ahead and highlight those in blue as I've been doing in the past, because operating cash flows are kind of a really important thing. The challenge with the way that we do this from a valuation standpoint is just doing a forecast out to year 10 doesn't really account for the fact that the business may have value beyond year 10. And so what businesses normally do is they calculate what they would call a terminal value. And the terminal value is basically making a simplifying assumption about what the cash flows will be beyond year 10, and then trying to bring them back to what their year 10 value would be. All right. And we will discuss this if we haven't already. We'll discuss it as part of the time value of money calculations. But basically, the simplifying assumption that most people make for terminal value on a project is what they would call a growing perpetuity. A perpetuity is a cash flow that just continues on forever, no defined end to it. And a growing perpetuity, it continues to grow at some percentage over time. And so under that sort of simplifying assumption, there's a very simple formula for calculating the terminal value, which is that you take the payment now, you take the appropriate discount rate, which we will just assume one for now, we haven't negotiated one yet, and you subtract from that discount rate the growth rate, and you basically divide the value by the discount rate minus the growth rate. So for our case, just to kind of put it into practice for you, the value that we're looking at is our 10-year operating cash flow. And we're going to take that, and we've got to figure out a reasonable growth or a reasonable discount rate, and I'm going to set that, and you guys are going to set that for now at 15%, and that's a number that's an assumption. We can change it after we've gone through and calculated costs of capital, but at this stage we don't know it, so we're just going to assume 15%. And so we take this amount and we divide it by the 15% minus, and I'm just going to plug it in. It's my one exception here. Actually, I'm going to go ahead and do it properly for you guys. Changed my mind. I'm going to add the inflation rate or growth rate. Let's just call it the growth rate. And we'll call that 2%. That way you can see what happens if you change that. So the terminal value is equal to that final value divided by 15% minus 2%. Okay, so it's equal to $3.6 million. Well, so what happens if we grow faster? Let's say we grow up 4%. Then obviously the fact that things are growing more means they're more valuable, so the terminal value goes up. What happens if we negotiate our cost of capital and it's lower than 15%, say it's 10%? Then that makes the value of the terminal value go up because we're discounting each cash flow back more. What happens if instead of getting 10% it goes up and it's 20%? Makes the terminal value worth less. What happens if we have no growth rate? That makes the terminal value less. So you can kind of play around with that, and we will certainly do some sensitivity analysis on it. 15%. Don't know why I did that. There we go. But for now, just do it at 15% discount rate and a growth rate of 2%, and we'll be all good. All right. Now, that gets us, quite frankly, all the information that we need in order to value the business. Okay. But it leaves us this one issue. Remember when I talked about businesses earlier, I talked about the fact that they run on cash. And since they run on cash, you have to know that you have enough cash. And so we're going to build out that cash balance now. And the first thing we're going to do is we're going to make some assumption about how much cash we're going to put in. Well, we know that probably we need more than this, but let's just assume that we were only going to put in, we thought, well, we're just going to put in enough money for, I'll just call it $1,200. That's what we guessed at the land and the equipment. All right. Now we're going to build out our cash balances, and that's an assumption, so I'll highlight that. We're going to put our cash balance in. Our cash balance is equal to whatever those operating cash flows are, plus whatever our capital contributions are. Okay, that's what it's equal to in that first period. Okay, and we have a problem here because we're $113,000 short. Literally what that's saying is on day one, we'll be $113,000 short. So that probably means that we need to up the cash balance a little bit. So we'll make it 1.4 million, and now we have about an $87,000 cushion there. Okay. Now in remember, this is in the period where we're doing the initial investments. We're calling it month 0. The cash balance in month 1 is equal to whatever the cash balance was in month 0 plus whatever the operating cash flows are in month 1 plus whatever the capital contributions are in month 1. All right? So because that was positive, it goes up a little bit and we're okay. And we can just string this formula out. Stretch it out and fill it out the whole way as well. All right? And what you want to do is you want to look and make sure that as you do this, you have no negatives. All right? Obviously, it looks like we don't. And in fact, you're starting to build up a whole bunch of cash there. I will tell you that ordinarily in a business, you wouldn't do that. You would start to do some distributions. That's what you would do in practice. You would either distribute the money to your investors, or you would maybe go out and open a second business or whatever it is. You wouldn't just let that cash sit there idle. But for purposes of the valuation of this business idea, we can't bring those other things in. So we just leave the assumption that the cash stays in and the cash balances will be what they are. All right. So at this point, you have all of your operating cash flows. You have your cash account balance to make sure that you have enough money, and you've defined an amount of money that you're going to need to put in cash-wise. So this is how much you're either going to contribute yourself or look for other investors to contribute in order to make the money, the opportunity go. So that's all you need to do at this stage. Keep doing this, sorry.